Now I will be talking about Chapter 8, CFA Investment Management Certificate 2013, Paper 1. The Paper 1, this Chapter 8, says about principle for businesses and then all the requirements the professional has to follow and also the candidates. So the principle for businesses are a general statements of the fundamental obligation of firms and under the regulatory system. They are produced by FSA, Financial Service Authority, and set out by standards expected from all firms. Must conduct its business with integrity, skill, care, and diligence. Management and control must take reasonable care to organize and control its affairs responsibly and effectively with adequate risk management system. Market practice. A firm must observe proper standard of market conduct. Customers' interest. A firm must pay due care to the interests of its customers. Communication with clients. Make them aware of every transaction and fee. Conflicts of interests. Must manage the firms must manage conflict of interest between itself and the customers and between customers and the other clients. Disclose all position available and also in the position that other clients have. Let's assume one client has a long position and the other one want to short it. The firm must be fair with both parties. And sometimes if you see some things that is gonna hurt any of the clients, it's better disregard of it. Um, Everything has to be mentioned for both parts. Customers' relationship with trust. Clients as asset. Relationship with regulators. All of it. The firm must make sure to take a sensible decision in order to keep the system unaffected. And also the corporate culture and leadership. Every organization has its own unique culture or value set. The culture of organization are created unconsciously. If the senior manager behaves in a responsible manner, the whole organization just follow in a similar way. A corporate culture is built around a set of states, values, or ethics. An example of unethics was Enron. Enron made its money through unethical and illegal practice. Enron executives were able to keep bond rating agencies happy by inflating their revenue and hiding their losses. And they also were able to sustain this through a persistent refusal to disclose to analysts who questioned the financial statements. The auditing firm just turned their eye blind because they did not want to lose their fee. So because they were involved in the money, so they just hide what they really knew about. So because Enron made a self-enrichment at the expenses of shareholders, a person to run a firm and the supervisor, or a person who is in charge, a person must be approved person. They take a SPS, that's taken a CISI, they issue it. SPS stands for standing statement of person standing. Must have a qualification for it. The person who is a SPS holder would ignore such action due to the discipline set by FSA. The FSA has issued a code of practice for approved person that set out description of conduct. So when the person dealing with investment or client's money, they must make sure, in order to keep the firm in a good reputation. Otherwise, the company may leave the